Good afternoon. Good morning. We've had such great engagements. It feels like we're at midday already with the previous session. Our next session now, it will be facilitated by Maxine Gray from Investec Wealth and Investments. And they will be taking us into the theme of responsible and ESG investing, a strategic imperative for funders. Maxine would introduce the participants and the panelists, and we'll take it from there. We'll take questions where Maxine will explain to us how we would be engaging on questions, but over to you, Maxine.
Great, thank you so much, Mabato. I hope everyone can see me and can hear me clearly. I think before we begin, there will be a poll that comes up on your screen. If I could just ask that everyone have a look at the poll, the questions relating to your foundation or the organization that you are representing, and to please select which one is most appropriate to you. So those questions should be up. There are 4 options, and yeah, essentially please just select which one is most relevant to you. So does your foundation or organization have a high awareness and practice of responsible investing and ESG investing? Please select the option that is most relevant to your organization or foundation now. Okay, has everyone made their selections on the poll? I think we will see the results of the poll coming up shortly, following which I will just give a brief introduction to this topic and then move on to the much more exciting piece of this session, which I'll be joined by 3 panelists covering this space. So the results are in, and as we can see, the one that has the most success, I suppose marginally, is that the foundation organization I represent has a high awareness and active practice of responsible investing and ESG investing, which is great news, by 32%. And then the other 3 are split equally, 23% each. So I hope that this session provides some introductory explanation for those that aren't familiar to it, and perhaps some further engagement for those that are already quite familiar with this topic. So I'm just going to start by sharing my screen and do a very short presentation on this topic, just to check that everyone can see my screen.
Yes, we can see your screen.
Perfect, great stuff. So I'm going to start off just by sharing with you, the spectrum of investment from its traditional to the most impactful range. I think we started out in the world of investments on the left-hand side in a traditional investment space, which really seeked to maximize financial return. And slowly but surely over time, we are moving closer and closer to the right-hand side into responsible methods of investing, sustainable investments, and those that are also impactful. So as a North Star of where we would like our investment trajectory to be going into, the direction of travel is sustainable investing. So what is sustainable investing? Sustainable investing is an investment strategy that seeks to consider both a financial return and a social environmental good to bring about social change. It is about investing in progress and recognizing that companies solving the world's biggest challenges can be best positioned to grow. Ultimately understanding that as an investment, you hope to hold an investment to seek a return. And so it makes the most sense that we align our investment strategies to companies that are best positioned to grow and to have sustainable success moving forward over the long term. So the impact or objectives of your trust foundation or organization that you are representing through your distributions should be aligned, or at least not opposing the impact of the underlying investment portfolio. I think it's important at this juncture to recognize that we have portfolios that are managed by an investment manager, and then the interest that is earned off that capital is what is used to facilitate the objectives of the trust or of the organization. So we must understand that there are 2 parts to this, and we want both to be maximizing the objectives of the trust or of the foundation in which you represent. So what is ESG and how does it fit into sustainable investing? At a high level, ESG stands for environmental, social, and governance. And it considers investment merits of businesses from the position or perspectives of how that business acts and behaves across a broad range of measures. So it's from how it affects the environment to how it treats its employees and the efficacy of the board of its directors. Essentially what it is it's a qualitative measure to understand that even though there are quantitative metrics behind that measure, but to really put some meat behind the behavior and the character of those organizations that accompany the financial metrics used to value those companies. So instead of looking at a company and valuing it based on just how much of a financial return it's going to make, our valuation of companies and the risk metrics applied now take much more holistic considerations into account when we delve into the world of ESG considerations. And more intuitively, perhaps, if we say this in another way, those with loose internal controls and oversight aligned to these themes will be more likely to destroy value over the long term. So it is in the best interest of investors and society and the environment alike to make sure that these ESG considerations are integrated into the valuation of companies. ESG considerations are then integrated into the investment decision-making and broader investment processes through 4 key components. The one is in research and screening, which is largely looking at screening companies across a whole range of metrics, ESG scores from a risk perspective, to understand how they are performing in relation to their peers within an industry group and within relation to other sectors as well. Then there's the voting piece of the component whereby shareholders and active investment managers as custodians of their shareholders' votes have a stewardship responsibility over those shares and over those investments to vote in annual general meetings, special meetings, and other meetings against or for whatever is put forward within those. That is essentially shareholders exercising their right to help shape the trajectory of companies along these considerations. The third is around active engagement with management. So if some of that voting doesn't reach certain percentages, the directors and the management of those companies are held by obligation to engage with shareholders. Some of the votes are binding and some are non-binding, meaning that even though they will need to engage sometimes, if the vote has reached a certain point, they will be overridden. So for example, when it comes to the appointment of non-executive directors on a board, or in a non-binding sense, where there will be engagement perhaps around the remuneration policy of that board of the company, but they're not necessarily forced to change, but rather just to actively engage with the shareholders in considering how they might change to move in a better or more sustainable direction. And the last is really around reporting. So this is, do you have a record of where you voted, how you voted, why you voted, when you engaged with management, etc. It's a holistic process that is the investment manager's responsibility to integrate into their investment process and into their investment decision making. Companies as investment managers can subscribe to CRISA in South Africa, which is the Code for Responsible Investing, or the UN PRI, which is the leading proponent of responsible investing globally. And subscribing to those bodies is essentially a public commitment towards sustainability. So one question you could always ask your investment manager is, do you subscribe to CRISA? Do you subscribe to the UNPRI, etc.? And working with both of those bodies really enables those companies to move in the right direction with guidance and make a commitment towards sustainability. So as a strategic imperative for funders, why is responsible investing important? If we just go back a little bit to what the purpose of philanthropy is, we understand that it is to improve the well-being of humankind by preventing and solving social problems. This can be done through grant making, but absolutely now we see more so that it can also be done by channeling your investment strategy in a direction that is seeking impact. First and foremost, making sure that that investment is not further contributing to the harm that we are as philanthropists and through distributions trying to solve in the first place. Where investment managers come into this picture is that as trusted stewards of their clients' assets have the objective to invest in a way that promotes and aligns to long-term sustainability. So investment managers at their core aim to invest in companies that are able to deliver cost of capital beating returns on a sustainable basis and over the long term, while retaining a commitment to all relevant stakeholders, not just their shareholders. This includes the societies in which they operate, as well as their staff. There's a responsibility for all to recognize the interconnected nature of our business, the economy, the environment, and society. It has been said that in the past, in order to do good, you have to do well in terms of CSI. Now, in order to do well, you have to do good. And that includes considering the entire environment and society in which one operates. So accordingly, philanthropic foundation investment objectives should consider the impact to the environment, as well as being able to generate cash flow returns on their capital in a sustainable way. Ultimately, what we're saying is that by having your investment objectives of the foundation aligned to ESG and responsible investing practices, you are essentially able to not only make sure you're not doing more harm to the environment or to society, but that you're also actually able to potentially have a positive impact, not only through your distributions, but also through your investment objectives. So that is it from me. I hope that that gave a relatively broad overall introduction to the topic for anyone that was not familiar. And now I would like to move on to introducing our panelists. So first, I'm going to introduce Mike Davies, who's the Managing Director of Kigoda Consulting, a Cape Town-based company that provides a range of services relating to sustainable and responsible investing. This includes all sorts of spheres, include with ESG issues, portfolio screening, responsible investment policy development, etc. And all these bios are exceptionally impressive. So I will just shorten them just to say Mike has had previous experience in the United Kingdom as well. Moving over to Steve Nicholls, who's the Head of Environmental Sustainability at the National Business Initiative and leads the Environment and Society programs at the NBI, as well as focusing on the SDGs and NDP. It is safe to say he has expertise across basically every single sector, including energy, climate change, water, mining, telecoms, government, electrical, energy, oil and gas, and the list continues. Steve has also had previous experience working from a consultant basis and advisory capacity in the United Kingdom. Last and surely not least is the esteemed Tracey Davies, who's the Executive Director of Just Share, which is a nonprofit shareholder activism organization. Tracey is an expert in responsible investment, shareholder activism, and corporate governance. Tracey also sits on the NBI Just Transition Pathways Advisory Board, the Global Reporting Initiative's Human Rights Technical Task Team, and was a member of the judging panel for the 2020 Principles for Responsible Investing Awards. In her spare time, she also writes a monthly column for the Financial Mail, and her opinion pieces are published regularly in a broad range of South African media. So I think it is safe to say I'm really joined by an esteemed panel of experts in their respective fields who will really help to delve and give some context and some depth to this topic. So I'd just like to remind everyone that if you have any questions, please use the Q&A function. We will try to get to as many questions as possible in the session, and any that are unanswered, we will be able to answer via mail after the session concludes. So I'm going to jump right into it and get to Steve first and say, there is a belief that sustainable investments or investments that take ESG considerations into account are good for society and the environment, but that are accompanied by lower returns, which, as we know, is something that philanthropic foundations cannot simply deal with. So Steve, could you give us your views on this myth, please?
Sure, yeah, thanks for the introduction. I mean, I guess the context to all this is we live in a very complex and changing world. I was looking at one asset manager website in this last week, and they had a phrase at the beginning that said, there's no guarantee that past performance predicts future performance. And at the end of the website, they had, there's no guarantee that forward-looking estimates will come to pass. So kind of hedging their risk on all sides, which I think reflects quite well the challenge that we all face and the role of sustainable investment. Really what we're thinking about here, as Maxine opened with, is can we find a more sophisticated way to think about the broad risk and opportunity in this vast changing world that we have? And ESG investing is kind of the answer to that. Let's think about other factors that aren't the traditional financial factors. Let's think about environmental, social, and governance. And I want to address this question about the myth with a legend, and go back to the 2010 BP Deepwater Horizon oil spill. BP lost $89 billion of market cap in 31 days. Fitch downgraded them 6 levels. And at the time, people talked about it as this like big black swan event. It's something that asset managers, investors wouldn't have been able to predict. And I guess with the benefit of hindsight, if we go back and look at some of the underlying factors, we see some interesting things. First of all, it was completely predictable. And secondly, it wasn't quite what we thought. It was S&G issues that led to a rather tragic E outcome. And so if you look at some of the stats, just prior to that Deepwater Oil Horizon leak, they had that Texas explosion that killed 15 people in 2005. Between 2005 and 2010, BP were responsible for 97% of all health and safety violations of a willful and egregiously willful nature in the US, which is a remarkable proportion. So there were indicators that could tell us that there were things going wrong at BP prior to that rather big spill. And in hindsight, there was a lot of evidence to say that BP just didn't do their job in terms of the engineering. But we could have predicted that, and we could have protected our portfolios from that loss. And so to kind of think about that a little bit more, and to answer your question a bit more directly, is there evidence that we underperform? Morgan Stanley, and I picked Morgan Stanley because they're kind of the doyen of capitalism. If there's anyone that's going to have taken a non-ESG route, it might have been them. But they've done a lot of study looking at data from Morningstar, looking at over 10,000 studies around the US from 2004 to 2018 to show that none of the ESG funds underperform traditional funds. And in fact, there's a substantial downside benefit. So the 20% smaller downside deviation than traditional funds. So that BP example is great because you kind of protect yourself from that downside risk. And we would expect that downside protection to become more visible in more volatile times. And so the more recent studies that Morgan Stanley have done illustrate that even more perfectly. So in 2019, ESG funds outperformed other funds by a median of 2.8%. And in 2020, maximum volatility, they outperformed by 4.1%, somewhere around there. So we can kind of see that downside risk protection playing out. And we also see that playing out in how markets are growing. So Deloitte in the study, also looking at US funds, predict that ESG funds are growing at 3 times the rate of traditional funds in the US and will make up about 50% of the market by 2025. And we see similar kinds of trends in South Africa, but also the sort of infrastructure protection being put in place as well. So Treasury, for example, are developing a green finance taxonomy for the economy. And we see a huge rise in green bonds and other sustainable investment instruments. So I think it's completely a myth and something we can talk about a bit more as we go on.
Thanks, Steve. I think, your choice of wording, replacing a myth with a legend, is extremely poignant in this space. I think, even for those that are just purely chasing return at this point of view, as you've pointed out, a lot of these ESG funds and a lot of those that are companies in particular that are aligning themselves to more sustainable ways of operating at the core of their strategy are essentially performing better financially. So, for those that really believe in ESG considerations, 100% it's the way to go. And even if you only believe in the financial return, it's clearly seeming like the right way to go, to the right way to go at the same time. So I think that leads me quite nicely into putting something to Tracey, as I know, Tracey, you engage with a lot of companies in terms of their transition into this space. And so as companies transition into being more conscious corporate citizens, some might see more value in being active shareholders in those companies, so being able to work with them to transition rather than divesting from them. On the other hand, disinvestment might be the only option in relation to companies which are not committed to this transition. Tracey, could you provide us with your views on the statement and perhaps illustrate some of the pros and cons about how shareholders can exercise their power in both cases, whichever one, of course, is more aligned to their ESG and overall objectives?
Thanks, Maxine, and good morning, everyone. Thanks for the question. So there's two elements to this. It's not just about the extent to which a particular company is committed to transitioning to a more sustainable way of functioning. You know, there are certain companies whose business models is inherently either unsustainable or doesn't fulfill ESG criteria, depending on your particular set of values or views. So, you know, the most common ones, of course, are alcohol and tobacco. There are a lot of asset owners who say, I will not hold any funds in any companies that deal in alcohol, tobacco. And then the sort of more recent one, but perhaps one that hasn't quite become mainstream yet, is of course climate change and fossil fuel companies. So, you know, if you want to make a very strong statement about a particular company's operations and your particular foundation's views on those operations and whether or not they're aligned to your mission, then divestment is the clearest and easiest way to express that view. And it's particularly useful and helpful, of course, if you're also willing to publicize or make public the fact that you have done that and why you've done that. Probably, you know, one of the best examples of that is the Wallace Global Fund, which is a US-based philanthropic foundation, which about 10 years ago decided that it was very clear that as a foundation that was supporting climate justice organizations across the globe, it was completely incompatible with its mission for it to be invested in any fossil fuel companies. And it completely divested from fossil fuel around a decade ago. And interestingly, the Wallace Global Fund's portfolio has outperformed the standard benchmark indices by a significant margin, really purely as a result of that move that it made 10 years ago. So it's a strong move, and it's one that South African investors tend to be very wary of, partly because of this concept of, you know, something your asset managers will always tell you in South Africa, that we have a small investment universe. And if you pull out of any one sector, you know, you're going to be risking your returns. So if we take that as a position of most asset owners, then, you know, active ownership, active shareholding is the best way to engage with companies as they become more sustainable or better ESG practitioners, if you will. But that is not as simple as it sounds. You know, across the world, changes at corporate level and on the ground level have come from asset owners, not from asset managers. Okay, it's the asset owners who direct asset managers to engage with companies from an ESG perspective. And so it's one thing, one important step, the first important step is for asset owners to mandate their asset managers to be active owners from an ESG point of view. But there is another step required, and I think this is where many people fumble in this space, which is that there is a big difference between the kind of public relations material of many asset managers in terms of their ESG engagement and the actual impacts of that engagement. So it's not enough just to say, okay, great, my asset manager says that they do all of these fantastic ESG engagements and monitoring of all the companies I'm invested in. The question you need to ask those asset managers is, what has changed as a result of you being an active manager in those companies? Because unfortunately, despite over a decade of so-called responsible investment, we haven't seen much change on the ground yet. And I think that is strongly to do with the fact that asset owners are not robustly enough interrogating the engagement, the ESG engagement practices of their asset managers.
Thanks, Tracey. I couldn't agree with you more. And, you know, the concept of complex contagion comes into mind here, where I think what we've seen happen with the disintermediation of media and news, social media, and the way, you know, within minutes, the whole world can know about something. Where that's really powerful in a positive sense here is that I think the more activity you see and the more ownership you see of the asset owners and the more pressure that is placed on asset managers, the more this spreads, you know, whether it seems to be the fashionable thing to do, or whether it's just really, you know, we have to do this, otherwise we're really going to be left behind. It's that concept of saying the more pressure we apply as asset owners, the more move there will be and faster moves and shifts there will be in this direction. So just like staying on that thought, I wanted to ask a question. I know that it was answered by Stephen in the chat, but really just Tracey, to give your views, I'll read the question and the response around ESG products on the market. So Steve replies, and the question is, asset managers say that there are very few ESG products in the market in South Africa that they can invest in. How do we respond to this? So Steve's response, it says, it is challenging. It is further complicated by the structure of the economy and listed options where a small group of shares dominate trade. However, asset owners need to push better ESG management into your mandates, given this protects your income and capital. So more active engagement is needed rather than passive engagement. There are a number of key transition risks that should be difficult to track for any qualified asset manager. And I think that ties really nice into what we're saying, is that, having a product that is looking at something as one thing in isolation is focused and impact in a particular way, ensuring that ESG is integrated. And to your point, Tracey, that the impact of that engagement is measured and can be demonstrated to those asset owners is complementary to that. So do you have any views or anything that you have seen in terms of people looking for, ESG, a response to that kind of question when it comes to this?
Yeah, it's a very common response, and as Steve highlights, it is a complex area, and there certainly are not nearly enough ESG options in the South African market. But that is also a function of what one asset manager I know calls the ESG cycle of death, which is that asset managers tell asset owners that there aren't many ESG products available, and asset owners go, okay, fine, we'll have to invest in something else. Whereas the asset managers say, you guys should be demanding this from us. You should be saying to us, okay, if you can't provide me with a product that suits my mission, then I will take my money somewhere else. This is something that happens very rarely. So there's a tendency just to accept that explanation. Having said that, there are products that are in development, and this is definitely a big space that people are thinking about and working on, very, very actively. And at the moment, it all feels like it's behind the scenes, but I think there will come a point where suddenly there'll be a whole range of options. But the only way, to spur innovation in this field is to create competition amongst the asset managers, and at present they don't feel that there's sufficient demand amongst their clients, or that their clients are pushing sufficiently hard enough to make it worth their while to develop these products. So it really is a cycle of death. And as I say, as I said in response to your previous question, in all the jurisdictions where you do see a much broader range of ESG products, that has been the result of demands from asset owners, from active pension funds, from active foundations, philanthropic foundations, university endowments. Those are the people who are pushing asset managers to develop these products. But at the moment in South Africa, they just don't feel that there's sufficient push to warrant their time.
Yeah, thanks, Tracey, for that. I think it's, what it shows us is that the power really is in our hands as asset owners. And now it's about saying with that power comes great responsibility, as we know. So Mike, perhaps you can shed some light on how we can exercise, and use that responsibility. So for anyone in the audience that is eager to now apply this and really start getting into those questions with their asset manager, with their investment managers, could you perhaps provide some guidance as to how to take the first steps in this journey? So what questions could one ask and perhaps safeguard against, some of the responses that would lead to shutting it down and just almost that acceptance of, well, we don't have that, or this is not available?
Sure, thank you, Maxine. I think the starting point is really to build a strong understanding of responsible investment in your organization, to understand the sort of issues that Steve's talking about. Clearly, in each organization, there's going to be different governance structures, different knowledge and understanding from different trustees, for instance, as well as the organizational representatives themselves. So the starting point is to build understanding, utilize the tools that are available from various organizations, workshops, trustee training, are all available, and that can then sort of be the starting point to take you down to the next step, which is about the investment policy. And That's really sets out the core principles that govern and provide the framework for your investment decisions and relate to how you then engage with your asset manager on those decisions. But even going through that discussion of what is going to be our responsible investment part of our investment policy statement, builds the understanding of the organization, sets your objectives, sets your investment beliefs. Do you align with your mission through your investment policies, or is it only a maximization of return? And if that is the case, how does that then align with your fiduciary obligations as trustees to be acting in the best interest of the trust? You also, within that policy statement, want to be looking at how you approach responsible investment, talking to the issues that Tracey was looking at about do we divest if engagements are unsuccessful? Do we have exclusions on, say, coal or fossil fuels? What is our sort of voting policy? Who votes? Do we vote? Do we let our asset manager do it? Do we only engage ourselves, or do we also only do that through our asset managers? So there's a set of principles that need to be formulated and set the framework. And only then, I think, can you really start to look at the mandates that you'll be providing to the asset managers, engaging with your current asset manager in order to say, here is our new investment policy statement. How do you align with this? What do you currently do? And setting the mandate. I know people are interested in products, and there are increasing numbers of products coming to market. But in many cases, just by setting that policy, you will be able to engage with the asset manager. They will have discretionary funds that are and abilities to create something that's not necessarily just available on the retail market, because of what you have as a set of organizations behind you as asset owners comes with a degree of power that the man on the street doesn't necessarily have, looking for ESG products being available. So that's about the mandate. So the questions then you need to ask, I think we've covered some of those already. You, Maxine, raised the issue of, are you a PRI signatory? Do you endorse CRISA? And clearly that's a starting point, but most of our fund managers do that. So you need to be able to ask questions that then uncover, what does that really mean? Are they sort of ESG light? Are they sort of actually strong advocates of ESG and actually acting according to those principles? Because some of the research we've done has shown that very many of the managers were even failing several years ago in fulfilling the basic obligations of transparency and disclosure according to CRISA. So it's like, what is your process? How do you engage on ESG issues? What is your vote? Did you vote in a certain way on one of the resolutions that Just Share proposed? And what does that say about then your commitment to ESG if you're voting against or for that? Are you a signatory to the Task Force for Climate-Related Disclosures? So you really need to go deeper than just a sort of, are you a PRI signatory? Are you not? If you're going to try and unravel, I think, some of these issues where we have many blanket commitments, but and box ticking, but not necessarily the same approach across the board.
Thanks, Mike. You raise extremely pertinent points, I think, around the case of intent versus impact. And it's one thing to have good intention, but really it's about saying, what does that mean? What can you show for that intent? And what is it that you can communicate of what the impact of that intent is achieving for the asset owner that is, placing their trust in you as a custodian of their wealth. So I think it's an extremely poignant point, and I'd like to just go to some of the questions now that are coming through. I'll just read the question out, and anyone feel free to take this and we can dialogue it. So the first one is around more, I suppose, a statement than a question, saying that asset managers can invest a significant percentage of their funds offshore, where there's a much wider range of products and opportunities, which is true, and does obviously have its own perks around exposure to global indices and exposure to diversification, etc. But there's a question then that brings it back to South Africa and says, is there any information on the size of assets under management in the ESG funds currently in SA? And I think before I ask you to answer that question, I would just say that I think it's very important to understand that by incorporating ESG considerations in an active management way by an investment manager, essentially what it can mean is that at least as a step one, that all of their holdings, all of the companies that they hold have ESG integrated into that. So they've basically taken the ESG considerations, added it to the risk score that is given to valuing that company and placed a premium. So essentially what that means is, you know, if I want a return from a company and they have a low ESG score, they're going to have to perform significantly better than someone else that has a higher ESG score in order for them to look attractive to me as, you know, as an investment manager. So it's important to understand, number one, the integration of the existing investment management decisions of the portfolio, and then obviously look at very specific ESG opportunities. Yeah, I'm not sure who wants to take this one. Steve, Mike, Tracey, any indication of the size of assets under management in ESG funds in particular in SA?
I'll just jump in on that one. It really depends on what you mean by ESG investing, what approach, because again, many of the signatories to the PRI will say, well, they're doing ESG investing, but it's just the extent to which you think they actually have developed the right policies and processes that allow for that sort of risk-adjusted return on an ESG factor to be adequately accounted for, and whether that's actually sufficient in aligning it with your organization or your trust mission in any extent. And as Tracey says, does the active ownership angle really sort of lead to results on the ground? When we look at performance, in addition to what Steve was saying about obviously the material impacts that ESG issues can have on financial returns, the actual academic evidence shows that by engaging with companies on ESG issues, by sort of calling boards to account for environmental, social governance, performance issues, there you can actually yield significant outperformance, whereas on the actual return arguments, it tends to be at least that you won't see negative returns. There's strong alignment with the arguments for active engagement. So you need to be able to understand that ESG is often used as a collective term with many different strategies underneath it. And so just saying there's a single number that accounts for the assets under management of those that are PRI signatories, I don't think is necessarily wholly useful. But that's probably, you know, because many of them will say they're doing it and it doesn't necessarily sort of indicate the same thing.
Yeah, absolutely, Mike. And I think it takes us to the point around this being a journey rather than a once-off event. So, you know, for companies and for asset managers, for everyone involved, that is about saying, you know, where are you at on the journey? I think that's quite important for people to understand. You know, are they, you know, starting the journey, but have quite a plan that is backed with resources, backed with a commitment, backed with metrics that can be tracked to show progress, and can we follow that journey along the road? I think first and foremost, it's about, you know, going back to what was mentioned earlier around gaining an understanding about, you know, responsible investing, and what does that mean to you? What does it mean, you know, in obviously in theory, but also in practice when you take your objectives into consideration at a trust and a foundation level. So staying on that theme, I'd like to pose a question, Steve, to you. And you know, are there any risks involved in terms of the process of changing your investment mandate from, call it, traditional investing into ESG? And how would you go about this in terms of timing considerations?
So I would say no. There are no real risks. I mean, basically what you're doing is you're making your governance processes more robust. So can't see too much downside to that. I guess there will be some challenges, particularly around expertise, trying to make sure that you've got the right expertise on your board, the right expertise in your asset manager. And so this is probably not something that you're going to do overnight. It's going to take a bit of time to think through your investment policies, to think through who you appoint as your asset manager. And you may need to work with your asset manager to help them understand the skill set they need to execute your mandate. But it's, you know, there are no downsides to this. And in fact, what's likely to happen is you're going to go on a snowball journey when you start to investigate these ESG risks, particularly in a place like South Africa, find how fundamental they are to the economy. So climate change, for example, a simple stat, the Climate Policy Initiative, a UK-based group of ex-investment bankers, basically did a study on South Africa's exposure to climate risk and conclude that it's 35% of GDP just in your exposure to the coal value chain. So South Africa's economy is deeply exposed. Like I personally think the JSE is probably 30% overvalued, because it doesn't take into account many of these risks. And then the flip side is what will emerge to take the place of these traditional companies that we invest in, and are we on top of that? So I only see upside, but to make the point that it's not something you're going to solve overnight, and it's something that you're going to need to apply your minds to over a fairly long period. But start now.
Yeah, and I think also, you know, for me, the risk is around not doing this. So the risk lies in, if you don't go in this direction, what ultimately are you going to be invested in? And, you know, if we look at even from the World Economic Forum, the top 5 risks to businesses. Now, this is not like, you know, it's purely just mandated by modeling and, you know, statistical measures of risk. Top 5 are related to climate and the environment. So that basically tells us that in order for companies to be not only exist, you know, not even trying to be successful, but in order to exist in the future, to be sustainable in terms of your longevity and success, they really need to be paying attention to what are the top risks that are facing them, which ultimately hopefully drives those companies to pay more attention to these risks and to take this into consideration into how they operate, how they produce. And, you know, I'll segue into the sustainable goals here, which really just is to say that there are, you know, there's this plan that was, all these goals as a framework, global goals that were agreed by all member states of the United Nations in 2015 as a blueprint for moving towards a sustainable future. So companies really don't have anything to hold them back to say, well, you know, we don't know in what direction or how to do this. There's a lot out there, and there are a lot of organizations engaging with companies to help them down this road. The other side of it obviously comes, as we've mentioned, from the asset holders side and people that own the assets applying pressure, saying, well, this is what we want. You know, at a very minimum, understand where it is that your investment manager lies on this journey. What are their plans to move forward? And how, you know, how easy is it to track that and to measure that? So yeah, I just wanted to kind of segue into the SDG conversation, because it is something that I think is becoming more and more widely accepted globally, and is perhaps another method of, you know, an area of discussion that can come in to say, you know, how does your company, you know, integrate the sustainable development goals into their strategy? Are they, you know, is there a commitment to this framework, etc. So a question, Tracey, that has been posed to you in particular is, does Just Share provide information on the ESG track record of companies? Where can board members access information outside of the company's annual and sustainability reports, which are often greenwashed? And I think, you know, bringing up greenwashing is an incredibly important point. If you could just touch on, for those that are not aware, you know, what is greenwashing and how can we, you know, try to get some independent sources of information to verify what is said?
Sure. So, I mean, of course, it is not, it's not easy to track this for a large swathe of companies in your portfolio. And that's why asset managers have big teams of ESG analysts. But for the most part, it is actually quite easy to get a sense fairly quickly of the extent to which a particular company is genuinely addressing ESG risks versus just greenwashing them. And so the greenwashing basically means that, you know, what is being said in public about that company's journey to sustainability, if you want to express it like that, is not reflective of the actual actions that are being taken. And I will give you an example directly from our own work, which is that earlier in this year, when Just Share ran a campaign around fossil fuel conflicts of the directors at Standard Bank, the bank repeatedly said in public, repeated a statistic that was in its sustainability reports to say that 82% of its lending since 2012 had been to renewable energy projects. And we disputed that in public, and we tried to tell asset managers that this was not in fact the case, and that it was a particular statistic taken out of context. But we found that all the asset managers we engaged with had simply accepted that at face value. Now that Standard Bank has released disclosure on its fossil fuel exposure as a result of civil society and investor pressure for it to do so, we see that actually over that period, Standard Bank has lent 67 billion rands to fossil fuels and 12 billion rands to renewable energy. So that is a beautiful example of greenwashing, that previously the 67 billion rands to fossil fuels appeared nowhere in Standard Bank's sustainability reports, but the 12 billion rands to renewable energy was put there in multiple situations. So when it comes to particular issues that organizations like ours focus on, climate change, for example, there's a huge amount of information available on our website about particular companies that are most exposed. When it comes to companies that may not be so much the focus of NGOs or other kind of studies, you know, often a simple Google search will reveal a lot. Look at the news articles about a company. Look at, has there been anything about its environmental impact, about its social impact? Have there been, you know, we've seen a lot of really devastating stuff lately around environmental activists being threatened, harassed, and recently assassinated for objections to coal mining. You know, so that there's huge amount of that kind of thing in the media, and that is the kind of thing that, you know, people who are aware of these issues and concerned about these issues in the context of their investing can go to their asset managers and say, look, I saw this article about this company the other day. What's happening here? What have you done? What have you said to the company? Are you engaging? Is there a plan? What is their response? You know, because all of these debates and conflicts happen outside the financial sphere as if they're separate from it. You know, what we're trying to do is bring those two sides of it together to say to investors, you know, you're a foundation with a mission to protect the vulnerable in South Africa. You know, you must care about the fact that you're invested in companies that are harassing and intimidating environmental activists in relation to the degradation of their communities, you know. So it's about trying to bridge that divide. So it's about being aware of what's going on in the world in relation to particular issues that you're concerned about, and then demanding answers from the people who manage your money about how they're addressing those risks.
Yeah, thanks, Tracey. It's comprehensive, and I think to some it might sound like, you know, this is a huge burden to bear, but I think it's really, if we just take some key insights from what we've heard today, I think the first and foremost is we replace the myth with the legend. So we absolutely now know that it's, statistically speaking, it is really not true that there are, you know, you have to forego some sort of financial return in order to achieve, you know, higher impact on the ESG side of things when looking at those considerations. There are ways in which you can do this. You can, as an active shareholder, an active asset owner, you can divest from a company, which is a really strong statement around saying, I'm not willing to support your activities. Or you can move in the direction of being an active, you know, actively engaging with the management of that company, which is largely done by applying pressure on your asset manager or investment manager, and making sure that you understand the impact of what they are doing in terms of, you know, how they are engaging in this context, and also then around understanding, you know, do you understand what you own? So what is in your investment portfolio, and what does that mean in the context of how responsible investing is taking shape in your particular portfolio? Once you understand what companies or what shares you hold of companies, you can start delving into, you know, the Google search of looking for anything related to those companies and really being equipped with information to engage in those conversations with your investment manager or asset owner. I think, you know, the last thing to just wrap up and mention is to say that there are many ways in which to do this, and this is a journey. So it's around truly starting the journey. You know, we say, you know, Lao Tzu said, every great journey begins with a single step. And it really is about taking that first step. It's about having that context and awareness and understanding, actively engaging and applying pressure. We know that supply and demand, you know, simple law of economics. We know that supply increases when the demand is there. So it's up to all of us to really be active, you know, advocates for this and to demand this. And we will see a shift as we have already started to see, particularly in the last 18 months to 2 years. So I'd just like to ask if anyone, before we close off, anyone of the panelists have any final comments that they wish to share. Tracey.
Yeah, I just wanted to quickly, first of all, respond to Lindy's question about the JSE tracking the ESG performance of companies. At the moment, that is via the FTSE Russell SRI index, Social Responsible Investment Index. But that is based on submissions by the companies themselves, self-assessment by the companies themselves. So I think everyone's pretty wary of that at this stage in time. And then as a final comment, I'd just like to say, because I think that this can feel very overwhelming and completely unfeasible for trustees who are doing what they're doing voluntarily, part-time, and who are not necessarily experts in financial markets. And that is that, you know, you don't have to address every issue or every company. If each foundation picks its personal biggest concern, biggest mission-related issue, and focuses on 2 or 3 companies in its portfolio in relation to that issue, then once everyone is doing that, we will have a really strong force addressing social issues, environmental issues, governance issues across the board. So I would say, in terms of to bring it back to your suggestion about starting with a single step and that this is a journey, also just bear in mind that, you know, no one is expecting any single foundation to address the entire globe's ESG issues. Pick something that you care about and try to make an impact in that space. And then all together, we will shift the whole system.
Thank you, Tracey. I think that is a beautiful note to close off and to say that we really do have, you know, a power in numbers when it comes to these themes. It's about all of us taking that first step and really doing and playing our part and doing our thing. And also, you know, the question that you posed, Indy, you can ask that to your investment manager. So what metrics do you use to track the companies in which you invest? You know, I know there are services such as Sustainalytics and others that companies can use, which they can obviously need to apply, you know, some bigger considerations to. But I think all these questions that you're asking us, you can direct to your investment manager as well, and start having this conversation with them in a very engaging way. So I'd just like to say thank you so much to Tracey, to Steve, and to Mike for sharing their insights with us today, and to close off and hand off and say thank you to IPASA for creating this space to have this incredibly important discussion, which I hope this is just the start of, and this has sparked some interest in this field. So Mabatu, with that in mind, I will hand over to you to close us out.
Thank you very much, Maxine, and the panelists. Very interesting conversations. And as you've said, that, you know, it's great to make space to talk about, you know, the financial side and where we take our investments, and in the greater scheme, I think in solidarity with global development goals. And I think it's quite important for us as foundations to consider it. Now, as we are nearing to a close, ladies and gentlemen, of our two-day engagements, we'd like to invite you to our poll and respond to the following questions. The poll will be coming up onto your screens. The first question says, what do you think is the biggest issue of concern for philanthropy in 2021? This is quite easy because it's a multiple choice. There's a number of responses. You just click one. First one, responsible investment of foundations, assets, and long-term management of endowments, the impact of climate change and environmental issues on society, or the need to address the deep systemic problems in our education system, which has been exacerbated by COVID. The second question is, what do you think IPASA can do to help address these concerns? Again, it's a multiple choice question. It's whether to bring funders together to connect, share and collaborate through issue-focused meetings, provide knowledge and resources on philanthropy's best practice. And the last one is on whether to provide a link between private funders, corporate funders, governments, and NPOs. While you are continuing with the poll, we have reached the end of our two-day symposium, and I will be sharing the responses of the poll as they come through. However, I'd just like to say that, colleagues and friends, that we've had an engaging and interesting 2 days, and I believe that we will all be taking away many ideas and lessons and insights from this wonderfully prepared program, and that there are insights for us as individuals in philanthropic practice, for our organizations as partners in development work, as well as for IPASA on enhancing its work by using its growing convening power in philanthropy in South Africa, and to encourage us to continue discussions and engagements on these great topics. However, as IPASA Council and Management, we would not have been able to pull this together without valuable contributions by individuals and organizations. Therefore, on behalf of the IPASA Council and management, I would like to express our gratitude to all the speakers who came from far and near, and to the panel members from both days, as well as the panel moderators, Paul Pereira and Maxine Gray, to Gail for chairing the best practice session, Sheila for overseeing the launch of the review of the South Africa Philanthropy launch, and to all the facilitators whom are all IPASA members for helping us with the breakaway groups, and to the symposium subcommittee for their involvement and inputs into the program, to Lauren Roderick for administrative support and keeping us organized towards this event, and to Louise Driver, who's the Executive Director of IPASA, and we think, you know, she has helped in driving all and bringing all these together. The events and technical team support, and most importantly to all of you for honoring our invitation, coming to join us and spending these days with us. Thank you, and thank you so much. However, in true IPASA style, we would like to say goodbye, but we know that many of you would like to continue networking and engaging with others over the symposium attendees. Oh, there we go. We've got the results. You know, I think on the first question, the key one that is coming tops is on what we think we need to concern ourselves with in philanthropy next year is on the deep systemic problems in the education system. 64% of you say that, and the climate change and environmental issues on society at 24%, responsible investment in foundations, assets, and long-term management at 12%. And the second one, what do you think IPASA can do to help address these concerns, to bring funders together? 38%, provide knowledge and resources at 14%, and provide a link between private funders, corporate funders, governments, NPOs at 48%. So what we'll do is post the symposium is to look at all of these responses and sort of set an agenda and look at how we can continue engaging on this. But as I was saying earlier, that, you know, in true IPASA style, we would like to say goodbye, but we know that many of you would like to continue networking and engaging with other symposium attendees. So if you would like to continue doing that, we have about some of the topics of today or of the past 2 days. There's a facility that have been put together, which is a private virtual rooms that are available, which you can join. The link is being posted on the chat group right now. And once you click that link, it will transport you to the networking event. And with that, ladies and gentlemen, I would like to say, have a great day further. Goodbye, and see some of you in the next networking session. Thank you.